Hello guys, what is happening and welcome to tonight's surprise live stream. So basically, the reason I'm doing this live stream is because I got like a few people reach out to me about some people, I guess. It's not something I've personally heard of, but apparently there is rumors going around on FinTwit from realtors. I think it's really realtors just clinging to some sort of hope of desperation for their job, that we're going to see 40-year mortgages. Now, when I actually started diving into this and taking a look at what different people were saying, it was all just a load of, like, they don't know what they're talking about. And that's just putting it bluntly. But anyway, I thought it would be a good live stream to do, to actually go through this and take a look at this. So we got Trent in the house, Robert in the house. Welcome everybody. Please hit that like button. It greatly helps get the stream out there. John, hey, how you doing? All right, so first thing we're going to go through is a article that's from 2008 from CBC. This is when they used to report a little bit more accurately than they do now. But anyways, we'll go through that. At the end, we're going to go through the yield curve, what's been happening there. Financial markets are sick right now. They're on a withdrawal from being drug addicts. Just think of it that way. The way markets are acting right now is very, very sort of ominous. I think it's very, very weird the way they're acting, and they're acting like somebody is sick. You've got now crude tanking and gold tanking, but the NASDAQ is still managing to remain positive. You've got yields going up. It's just all over the place right now, to be totally honest with you. We'll talk about that at the end. I was going to do a video yesterday on currency volatility, but I had a splitting headache and I just went right to bed at 6:20. Nice and early, but I got up at 4:30. So, it's just the way it goes. I have to wake up super, super early. So anyways, let's get into this and find out. So we'll go through this first. The end is here for the 40-year mortgage. October 2008. So this was around the time that Lehman went under. So let's take a look and see what they're saying here. In an effort to stop a US-style mortgage meltdown in Canada, less than a year after the government guaranteed 40-year mortgage. Hold on. I'm just trying to resize this so I can actually read the darn thing. All right, there we go. All right, so let's start that again. In an effort to stop the US mortgage meltdown in Canada, less than a year after introducing the government-guaranteed 40-year mortgage, the Department of Finance is tightening the rules that apply to them. Effective October 15th, the maximum mortgage amortization period for new mortgages will be reduced from 40 years to 35 years. All mortgages must have at least 5% down payment. Home buyers must have a minimum credit score of 620 and a maximum of 40% of total debt service ratio, TDS score. The amount of gross income that is spent on servicing debt and housing related expenses such as heat or condo fees in brackets. Responsible and measured approach to reduce the risk of a US-style housing bubble developing in Canada, the Department of Finance said in a news release. The government said the measures will apply to new government-backed insured mortgages. Canadians who already hold mortgages will not be affected, the release says. Banks will continue to process applications from clients who have applied for a 40-year amortization period prior to October 15th. ING pulled the plug in July. ING Direct Canada became the first domestic lender to officially pull the plug on the controversial 40-year mortgage. So this was in July of 2008. Even though only 10% of its mortgage customers hold the 40-year mortgage. CEO Peter Aceto said, "It is really not in the best interests of Canadians." Yeah, and we'll go through why not after we've gone through this. But I find it very, very interesting that they put controversial 40-year mortgage. So still very controversial today, but even more so than back then because prices were obviously a lot lower back then. But as you can see, the demand for these mortgages wasn't even that high. It says right here that only 10% of its customers held 40-year mortgages. So the demand wasn't that high either. Because let's face it, most people aren't stupid. They know that they're going to be in debt for life with that, which is essentially what mortgage means. It's French for death pledge or something like that. I can't remember the exact thing off the top of my head, but it's something like that. So mortgage insurance protects lenders when a borrower defaults by making up any shortfall needed to repay the loan if the sale of the property doesn't cover the debt. Federally regulated lenders must have mortgage insurance on loans where the buyer's down payment is less than 20% of the price. The CMHC is a crown corporation as well as private insurers provide mortgage insurance. The government of Canada backs the CMHC and also private mortgage insurers so they can compete with the CMHC. Just over a year ago, Parliament passed a bill changing mortgage insurance by allowing a 40-year amortization period, thereby making the process of buying a home that much easier. And now it says they're actually more popular. I haven't even read this. So the Canadian Association of Accredited Mortgage Professionals estimates that 37% of all new Canadian mortgages taken from the 1-year period ending in the fall of 2007 were no longer the standard 25-year amortization period. While longer amortization periods can facilitate lower monthly payments, they are widely criticized for burdening homeowners with substantially higher total costs. According to a TD Bank representative, about 60% of first-time FOMO home buyers were opting for a 40-year mortgage. I slid in FOMO there. That wasn't in there. Which indicates that they are having a hard time affording the house and need to stretch the payments in order to make the purchase. Okay, so we've gone through that now. So the next thing that I want to bring up is real residential prices here in Canada for homes, because and really you can apply this to any country, New Zealand, Australia, the US, were they to bring in similar products, because they all have similar products, all these countries, even in the UK. So essentially, let's bring up the real residential home prices here so we can see what effect that actually had on home prices. Okay, so here's the chart. So I've narrowed it from 2005 to 2011 so you can see what's going on here. So it is an index, unfortunately, so it doesn't give us actual prices, but we can see whether prices were going up or prices were going down. So they bought this 40-year mortgage in, let me just check, a year. So this was a year. So they're saying, so it was probably in Q2 of 2007. So let's take a look to Q2 of 2007, which is right here. And then they stopped it. So prices, so one thing that is worth noting here is prices weren't declining. So they brought this in and prices were not declining at this point. This was still in the bubble. So that is an interesting point to reference right there. So they bought that in, prices went up, and then they took it out in Q3 of 2008 right here. So prices were going down when they got rid of that. So think about that. Prices were going down when they got rid of that. Not the, so they brought this in when prices were going up and they took it away when prices are going down. And one of the reasons that I'm sure that they took it away was because of risk on the government's behalf, because they were backing all these 40-year loans. And the fact is, if prices go down, it very easily wipes out any little equity that somebody has if they have a 40-year mortgage, as we're going to see when you look at your different payments, different interest rates, amortizations. you'll see that you start off by paying mortgages, by paying the interest down, and then you pay the principal down. So you pay principal and interest, but it's mostly interest towards the start of your mortgage, and then it goes more and more towards principal towards the end. So it's very easy when you first get into a mortgage to go underwater on it. So that is one thing that people on FinTwit got completely wrong, because they were saying that 40-year mortgages were bought in to backstop the housing market when housing prices were falling. Well, it's actually the complete opposite of what they are saying. It was took away when prices were falling. Just like you're seeing many of the things being took away and many financial regulations being toughened up right now as prices are falling, because the government is looking and they're going, man, oh man, we do not want to be on the hook for the $2 trillion of mortgage debt that, you know, we've insured or whatever, that is mostly subprime, let's face it. And God knows how much of those are liar loans where people have lied on their mortgage applications. It's just, I don't know if that's an actual word, but I just came up with it and it kind of has a nice ring to it, liar loans. That's what they essentially are. So it really is crazy that they're saying that they bought it into backstop. That is factually incorrect, and we've seen it right here. So that thought experiment is that concludes that part of the video anyway. So let's move on to what it means for your payment. How much does this actually impact the payment? This was my first thought when somebody sent me this, was, well, how much of a difference is that really going to make on your payment? And the reality is, just stretching it out to a 40-year term does not make that much difference, but it makes a massive difference on the risk side of things. This is why the 40-year mortgage had to be backed by the government, because nobody is going to want to buy mortgages that for over 40 years, because the risk premium is going to be so high that borrowers aren't going to even want to buy them. That they'll effectively be not cost effective to sell, because the risk premium would be so high that the rate would be so high that it wouldn't be worth, you'd be better off doing a 30-year term, because the payment would be higher on the 40-year term because the interest rate would be so much higher. So it is alarming. And you know, Canada's financial system, and I'm sure New Zealand and many others, is just built on nothingness. It's built on complete garbage. And the sooner people wake up to that fact, the better. You know, there's a guy, and I can't name him, but he's a subscriber of this channel, and I've chatted to him a number of times, and he told me that when it comes to insured mortgages in the compliance department, he used to work in compliance in the banks, looking at these mortgages that were coming through. And he used to say that if it was an insured mortgage, nobody gave a damn about that. People were told, we don't care about that. Just do the bare minimum that regulations tell us to do, and that's it. Don't fact check anything or anything like that. So that's what they do, and these insured mortgages are just an atomic bomb. And who's on the hook for it? The taxpayer. But I'm sure that the government is going to try and shift a lot of that onto the banks when it implodes. And that is going to lead to the banks not wanting to lend, because they're going to have so much credit losses occurring. They're going to be losing a lot of money, and they're not going to want to lend. So this is how financial conditions change in real time. Is, banks won't want to lend. So rates can be extremely low, like they were after the GFC in the US. And there's no willingness of the banks to actually lend. Now, there wasn't a blow up in Canada, as I discussed before in a prior video, which I'll link in the pinned comment, because I think it's important for people to watch that video, is there was no private debt bubble back in 2008 in Canada. So it really started in 2008, and then it continued and morphed into a bubble. But the US had a private debt bubble. So what happened is, when the GFC occurred, all of a sudden the banks didn't want to lend to the businesses anymore, and the businesses were dependent on that credit, so therefore unemployment skyrocketed and loads of people lost their jobs as a result of that. So basically Canada didn't have that much reliance on private debt back then. So the companies in Canada, they were actually more cash rich than the ones in the US at that time. So that meant that even if the banks didn't want to lend, they were okay. So there was an initial spike in unemployment, but it didn't last because companies were in a okay position. They weren't in the best position, but they weren't in a position like the US. Well, it's the polar opposite right now. Companies are just absolutely over leveraged to the hills. So when this all blows up, they are totally dependent on credit. Unemployment will skyrocket, and God, who knows what the government is going to do, because they're always going to try and do something. Maybe they'll start the Socialist Republic of Canada where everybody just works for the government. I don't know. And nothing would surprise me in this country anymore. I'm telling you, some of the things that have happened over the past 2 years have made me question this country and its leadership. I mean, the leadership was bad before, obviously, but I mean, what it has brought out over the past 2 years. Anyways, let's not get onto that. So let's bring up this mortgage calculator so I can show you exactly how much that means for the payments, because then it will make sense to how little effect this really has, or would have, even if they were actually stupid enough to bring this thing in. So if the government was stupid enough to bring it in. So basically, you're looking at this simple mortgage calculator. And here you can see that basically you've got the debt and then the equity that you build. And you can see that the debt goes down and the equity only really starts climbing past the debt amount like towards the end of your mortgage, like 20 years in. So anyway, I've got 500,000 at 2%, okay? So we'll start off with 2%. So $500,000, which is low for Canada considering the average price of a home here. But $500,000, 2%, 30-year mortgage comes out at a payment of $1848.10. Okay, so let's change this now to 40. So it goes down to 1514. Where is my... I've completely lost my pen, but 1514. So let me just calculate what the difference of that is. 1848, 1514. So it's a difference of 20% in the payment. And I want to be clear that this is when rates are at 2%. So this was the lowest they got during this pandemic, the lowest they've ever been. So when the 5-year fixed was at 2%. So that would be an 18% saving on your payment. So that's quite substantial. So now let's go to real world. So right now, so 5% right now and a 30-year term, that comes out to 2,684. Okay, so 2,684. And then if we put in a 40-year term, the payment goes down to 2,410. Okay, so that is half now. It's 10% difference in the payment. So it would make 10% difference in the payment if they were to put this in today. But better than that, let's reduce the rate 1% now. So let's instead change it back to a 30-year. So we're back at 2,684, as you can see on the screen here. And we're going to lower the rate now to 4% and see what the payment works out to be. 2,387. So it's 2,387. And the payment on the 40-year was 2,410. So that goes to show you how little effect it would have even if they put it in. you've got more chance of mortgage rates dropping from 5 to 4% than you have of that happening. Because why would they do that? It would make little to slim to no difference. Mortgages would still be incredibly expensive. The risk would just absolutely have skyrocketed, and the risk would have skyrocketed for who? For who? The government. And this is all at a time politically where housing prices have really been driven to the forefront by the opposition, and they are really being leveraged against the current federal government. So the current federal government wants house prices to go down. The Bank of Canada wants house prices to go down because it affects the CPI. Now, okay, it's a bogus CPI and it doesn't affect the CPI much, but it does affect the CPI. So they want house prices to go down. The trip that people make, and they make it time and time again, is thinking that politicians and central planners actually care about them, because they don't. They are sociopaths. They don't care about us. They really don't. And they don't have a clue how even the system that they govern even works. As Pierre has pointed out with asking questions in the finance, with the finance department. If you go and look on YouTube, you'll see when he asks, where does the money come from for the budget? And nobody can answer the question. And that's just the reality of what you have. And it's not just here in Canada. I'm sure it's in the federal government in the US. I'm sure it's in New Zealand and Australia as well. It's just prevalent. So the fact is, this 40-year mortgage story, it is just not likely to happen. Could it happen? Yes. Would it have much of an effect? Absolutely no. Mortgage rates have absolutely skyrocketed to 5% within such a short period of time. You still haven't got people paying that 5% rate yet. That is going to take another 2 months from now so that people are actually paying 5%. So everything has a lag until it affects the market. Now, normal retail investors, normal people purchasing in the market, they don't know this. They don't have a clue, and they're just often operating based on emotions or FOMO or whatever it is. So they're not looking at these things, but it is an interesting thing, and that's why I thought it would be a good stream, because I thought it was an interesting thought experiment, as my buddy George always says. But you know what? It is really interesting. Now, I want to mention real quick that on Friday, I'm going to be doing a video. Well, I might do it, I might not. A stream, should I say. Let me know in the comments if you want to see this. But I was going to do a stream about Airbnb, because I've been doing a lot of research on Airbnb. Obviously, Airbnbs were never around when the Great Recession happened. Yeah, there was like VRBO, Home and Away and stuff like that, but there was never Airbnb. So a lot of people have got into this Airbnb. It's become a side hustle for them or whatever, a business. So look, let's be honest with each other. During a recession, the amount of travel that's going to happen is going to plummet, as it did during 2006. So you're going to see the same thing happen, and it's going to be crazy. It's going to happen fast. It's already happening. Kirsten, thank you so much for the super sticker. Thank you very much for being on the stream. And thank you so much for supporting the channel. I know you've been here long time. And thank you so much. I really, really appreciate that. So this travel industry situation, I think it needs to be uncovered, because again, like everything, when I start looking into these things, you start removing the curtain and you realize the whole place is just on fire behind there. Like, it's once again just the elephant in the room, which nobody is talking about, which is Airbnb. So I'm thinking about doing that stream on Friday, or the currency one. So let me know in the comments. I do these things for you guys as well. They're not for me, they're for you guys. So let me know in the comments which one you would prefer. I can do the other one, sideline it for a different time. So it's going to be very, very interesting. Jose Bart says, what is your outlook for oil over the next 1 to 2 years? Do you see it drop like it did after 2008? Yeah, so it is going to drop like it did after 2008. I mean, we're already seeing that right now. I think it could go all the way down to $60 a barrel. But I think once everything comes in, that demand isn't actually waning because oil supply is so constrained and there's so many issues there, that the prices will come straight back up. Now, it's going to be very interesting to see how deep this recession goes, and that's really what's going to affect oil. So it's going to be very, very interesting. I sold all my energy stocks way back. I even put it on Twitter. I sold them before it was even at 130 a barrel or whatever. I think it was close to 100. It was before even 100, I'm pretty sure. And I sold all my oil stocks, and that was really because oil was getting expensive. And like George, I sell things when they're expensive and buy them when they're cheap. With stuff like that, I don't try and time the market too much. I thought $100 was going to be a massive resistance, which it turned out to be. But the thing is, oil prices, it's very hard to predict because it's all based on supply and demand. And we really don't know how deep this is going to go. And it's going to depend a lot also on China. So it's very dynamic, the oil market. We have to just keep monitoring it. It's very difficult to forecast things. But let's say because supply is so constrained, that is going to have an impact at some point. So I think oil prices will go down. But I do think they will come back pretty quickly. And I see the same thing happening with gold. I've said this many times. Gold will go down in price and it will come back up very quickly, just like it did in 2008, because people will realize there's no safe place to go and they'll all rush into gold, and that will push the price higher. Now, right now, you've got people pricing into the fact there's more Fed rate hikes. It also seems like the markets are really, really deteriorating badly right now. And I know the stock market, a lot of people are looking at the stock market and thinking, well, the stock market's not doing too bad right now. It's just kind of flat. But really, it's all the moves in the currency markets, all the moves in commodities, it's just broken right now. The whole system, the financial markets are not operating as they normally should, and it's a sign that things are bad. So yeah, it's pretty bad. I love you too, Kirsten. Thank you so much for being here. Why do you think... Oh, yeah, I just answered this. So, Trent, I got you there. I got you covered, buddy. That's why I think gold and silver. Because hedge funds are going to sell whatever they can, whatever's liquid, to cover their margin calls. That'll be gold. That'll be oil. That'll be silver. You know, oil is black gold, essentially. That's what a lot of people call it. So that is why. And there's also the demand theme and the fact the Fed is raising rates as well. So the fact the Fed is raising rates and the dollar is strengthening is bearish for gold. And that will go for some time. But gold, in my opinion, is a long-term thing for me. But it's like I said, I expected this to happen. It's going to go down. I think it could go down further, but I think the bounce back will be fast, like it was in 2008, like it was in 2020. And that really, gold, I don't really see it so much as an investment. I see it as an insurance policy, especially when you look at the volatility in currencies. And, you know, Brent Johnson is somebody that I follow, and I follow him because I think he's spot on with his dollar milkshake theory. There's a lot of different people on both sides of that argument. Peter Schiff as well is a big gold buff. And it's really the dollar milkshake theory, and everything Brent said, he's been spot on right with. The dollar, the DXY has absolutely surged. And that is why I hold a lot of currency in dollars. And dollars is the reserve currency, whether you like it or hate it. I don't like it, but it is the reserve currency right now. So it's what I'm holding. At some point, will I start to hold Chinese yuan? Probably, because that looks very much likely that it will be the reserve currency at some point in the future. Will I want to hold that? No. But again, it's just like you've got to realize these things, and sometimes you have to do things that you don't want to do. And the other thing to note, guys, is with what's happening in financial markets right now, if we see disinflation, and we very well could see disinflation due to the oil market. I mean, gasoline futures are down like 28% now in a couple of weeks. So that is going to bring down prices at the pump very fast. And that could mean disinflation. So if the stock market sees disinflation, especially the NASDAQ, the more speculative indexes like the NASDAQ and the S&P, which is comprised a lot of tech stocks, they could very much just surge off the fact of that. Now, I don't think they go to newer highs or anything like that, but the stock market could definitely make a temporary low. And this is what I was talking about for potentially some swing trades that I may put on as a hedge, because if that happens, I think there's a strong probability that you're going to see a relief rally of some description in the NASDAQ. And why not capitalize on it? I don't like these tech stocks, but I make money. Like, it's money. Like, I'm not going to turn that down. When it's high probability, that's what you go for. So we'll see what happens anyway, and that's not financial advice. I think I saw Scott in the house somewhere. I lost him. Yes, Scott is in the house. So I was just chatting to Scott, and we're going to do a live stream. He's down for it. So we'll be talking about his experiences and everything like that with foreclosures, which will be fantastic. I can't wait to do that because he's got so much good stuff to share with you guys. And one last thing that I wanted to show you with this 40-year mortgage deal is where the government debt is. If you look at the government debt, just like most Western countries, is the government in a good place right now to take on extra risk? No. No. I mean, look at the amount of debt they took on. So it is really, really bad for the government what is going on, and especially currencies outside of the US dollar, because if currencies continue to fall like the Canadian dollar, then that means it puts more pressure on rates staying higher. It means no stimulus. It means inflation can go higher as a result of that. So it's pretty insane. So I'm trying to get rid of that. I can't get rid of it now. Oh, there we go. I think it's there. It's still there on my screen. I don't know what's going on. But anyways, one last thing that I just wanted to go over was the yield curve, and then we'll wrap it up. Oh, man, I feel like this wasn't my best tonight. Every time I feel like that, everything does really amazingly, but I don't know why. I just feel like I'm off the ball. Maybe it's because I felt so crap last night. I have no idea. But anyway, let's take a look at this. Okay, so this is what I wanted to check in with the yield curve. So the 1 year is at 1.23. It's inverted over the 2s, the 5s, the 10s, and the 30 years. So the yield curve is completely inverted pretty much all the way through from the 1 year. Now, you remember me saying maybe when we talked about the yield curve in the past that when the 1 year inverts, that means that financial crisis is coming very shortly. And I stand by that. So there could be some sort of catalyst that happens very soon. And by very soon, I mean within the next 6 months, now that 1 year has inverted. It's not a good sign. So bonds were up today, but they're hovering around a support area right now. They dropped all the way down to a support, and they're hovering around that. There was a little bit of a yield rise today. The UK gilts are, still extremely low. New Zealand up. That's interesting. New Zealand hasn't really seen that much of a bond buying situation. If we go to the 3-month. Oh, yeah, they have. Yeah, they have. Wow, I did not see that the New Zealand 5-year got to over 4%. So yeah, New Zealand's done the same thing. It's dropped down to this support level here. Oh, you guys can't even see what's on the screen. But anyways, it doesn't really matter too much. But yeah, so let's go back to this. So Australia's up and the Treasury's down. So the Treasuries, the US Treasuries, is the yield curve inverted. The 2 is over the 10. The 30, no, it's not. It's not. You've just got the 1 year. No. Yeah, the 2 year is inverted over the 5 year and the 10 year, but not the 30 year. So there is some inversion in the yield curve. But let's face it, guys, I don't even think at this point we need the yield curve, even though it's inverted anyways. I think we know a recession is here. And if you start to look at Airbnbs local to you and everything like that, take a look. Are they booked up? Are they not booked up? Because what I'm seeing in the markets that I monitor, which are these places that have boomed, like the Okanagan, is a lot of bookings have suddenly opened up in the middle of summer when everybody goes on vacation. So people are canceling. They're canceling their vacation. When you look at them, make sure you're looking at ones with free cancellation, because those are going to be the ones where people go, yeah, we're canceling it. Obviously, if they've already paid for it and they're not going to get any money back, they're less likely to cancel it. But most people have free cancellation on there now because of the whole pandemic. And let me know, guys, in the comments below what you think about the live stream on Friday. Should we cover currencies and what's going on there, or should we cover Airbnbs? Obviously, either or will be covered at some other point in time, but I just want to know which one you would prefer to see. So anyway, please hit the like button if you've enjoyed this, and thank you so much for being here. Kirsten, thank you so much for the super chat. Trent, Trader 586, Scott, Kirsten, Mark, Robert, all you guys, thank you so much for being here tonight. You have a great rest of your night, and I will see you in the next one. Peace.